You can hear me, right? You can hear me clearly. So I'll share the screen. Okay, and then I'll give you permission so you can record it yourself. Okay, now start recording. You can record it. Okay, have you started recording? I don't think so. Let me know when you start recording. Okay, okay. Okay, so now, okay, now this is what happens. Okay, now for us to consider this as strong high, okay, for us to consider this as a strong high, price has to take out liquidity, okay, take out liquidity and then break structure. It has to take out liquidity and then break structure. So if this happens, okay, we're going to consider this high right here as a strong high. Okay, this will be a strong high. So what happens is, okay, price will come back up and then fall back down once again. Okay, so now this is the classic market structure that everyone is looking at. This is the high, this is the low, this is the lower high, and then this is the lower low. Okay, so now if you know smart money, this is what we call the breaker block. Okay, this is what we call the breaker block. Right here is the breaker block. Okay, so have you heard of the breaker block? Okay, a violated order block is just a breaker. Okay, remember it that way. Okay, because this was the push up that went back up and then took out all of this liquidity and then fell back down. Then price will come back up into that. Okay, because the first move up always comes into the breaker, into the breaker and then falls back down. So now we might have order blocks. Okay, we might have an order block right here, and we might have another one right here. Okay, now this is just an example. Okay, I'm just giving you the basic idea. So we might have an order block right here, and we might have another order block right here. So which one should we choose? That's the problem. Okay, that's the problem everyone has, like, because there's so much of order blocks everywhere. Like, which is the right order block? Which order block should I choose? That's the problem. Okay, so now remember, for a high probable point of interest, okay, for a high probable order block, there needs to be liquidity resting below it. That's the thing. Okay, there needs to be liquidity resting below that order block. So now just think of this. Okay, this is where all of the traders will enter the market. Because why? Now, if you know support and resistance, this is what we call a SNR flip zone. Okay, this is a broken support turning into resistance. Okay, a broken support turning into resistance. This is where that happens. So what do the retail traders use as confirmation? Once they see a bearish engulfing candle right here, they're going to sell, stop loss above this high. Okay, so now the support and resistance traders will have their stop loss above this high. And the break and retest traders, see, price broke this low and then retest. So even they would enter right here. And then we have the breakout traders. The breakout traders, what do they do? Okay, so what have they been taught? If price breaks structure, and if it comes back up and breaks structure once again, those guys are gonna consider this high right here as a strong high. Okay, so what do they do when they find out a strong high? They place their buy stops above this. Okay, they place their buy stops above this. And then the smart money traders, what will they do? They will say this is the lower high. Okay, so they do not want this to break. Okay, they will look at an order block somewhere around here, and then they will have their sell limit right here, stop loss above this high, targeting lower prices. This is what the smart money traders would do. Okay, but now I told you, for a high probable point, for a high probable order block, there needs to be liquidity resting below it. Okay, there needs to be an inducement. Okay, an inducement, that's the thing. Okay, the inducement is the main thing that we should look for when we look for an order block. Okay, what an inducement is, it's just a trap. Okay, it's just a trap created by the market makers. It's just a trap. Okay, now just think of this. Everyone will be looking at this high, because why? This was the last lower high, so they do not want this to break. Okay, no one wants this to break, so that way they have just engineered liquidity. Okay, this is what this high right here is, what we call the engineered liquidity. Okay, engineered liquidity, which means this is created by the market makers just to trap the people. Okay, now just think of this. How much of people have entered the market from this high? Okay, the people now, once again, this is a flip zone. Okay, so the support and resistance traders would enter here, break and retest traders would enter here. Okay, smart money traders would enter here, supply and demand traders would enter here. Okay, and the breakout traders, they will consider this as strong high and put their buy stops above this. Okay, so now this high right here, has turned into a pool of liquidity. Okay, this high right here has turned into a pool of liquidity. Okay, there's like so much of liquidity resting above this high. There is so much of stop losses, there's so much of buy stops, there's so much of things resting above this high. And we know that, okay, wherever liquidity is, market will, the price will do a manipulation. Okay, if there is liquidity, the price will do a manipulation. Okay, price will just wick and then fall back down. That is what they will do. Now just think of this. This is the inducement. This is the false thing that the market makers are showing you. Okay, this is something false. We do not trust this. So now remember, for high probable order block, there needs to be liquidity resting below that. So now we're not going to look at this, because why? Now, if you're going to look at this order block right here, where is the liquidity resting below that? See that? There is no liquidity. There is no liquidity. But just think of this order block right here. Let's say there was an order block right here. Now this order block has a pool of liquidity resting below. See, now this high right here is feeding liquidity into this point of interest. Okay, this high right here is feeding liquidity into this point of interest. Then what happens is, okay, price might come back up and then give a good reaction like this. Okay, once they give a good reaction like this, even like more and more people would enter the market. Okay, more and more people would enter the market, because why? Price went back up and then now it gave a good reaction after it mitigated this order block. Okay, and like what are they doing? What are they doing? They're engineering liquidity. Okay, they're inducing people to do the wrong thing. And then some might even see this as a trend line for me, like this. Okay, now just think of this. There is so much of liquidity resting above these highs. Okay, there is so much of liquidity resting above these highs. And then like price might come back up, might give a little reaction once again, and then fall back down. See, now even more and more people would jump into this trade. But then comes the right move, like this. Okay, it will come back up. We'll take out all of the stop losses of these early sellers. Okay, like now they were right. Anyway, the price was in a bearish market, but they were too early. Okay, they sold too early. Now the traders who went short here from these highs, from this trend line, from this order block and all of those, everyone will be taken out. The stop losses of all of these traders will be taken out. And once price breaks this high, once it breaks this high, the buy stops have been activated. The buy stops of these breakout traders have been activated. And then if they stay here for a long time, the people with buy stops here would like close it in profit or even put it to break even. So what they do is they come back up quick and then fall back down. Okay, this is what happens. So this is the entry that we should always look for. Okay, this is the entry we should always look for. Okay, stop loss can either be above this or above this. That's up to you. Okay, I would do this personally. Okay, I hope that's clear. Now this is the entry we should always look for. Okay, I hope that's clear. Do you have any questions about that? No, right? Can you send it in the chat or anything? Can you understand this? Yeah. Okay. Let me know if anything's unclear. Okay. Okay. So this is example number one. This is example number one, and then price can do something like this. Price can do something like this. Okay. Now what has happened? What has happened? Like what have the smart money traders been taught? Okay. Choose the order block that broke structure. Okay. Choose the order block that broke structure. So now we might have an order block right here. Right here we might have an order block. So because why? This was that order block that broke this major structure. Okay, this was the order block that broke this major structure. So what will the smart money traders do? Okay, not only the smart money traders, even the breakout traders, like all of them would say this was the high that broke this structure. So what are they going to do? They'll have their sell limit right here. Okay, stop loss above this high. No one is going to put it above this high, because why? They are so concerned about the risk to reward ratio. No one is going to put it above this high. They will have it above this high. Okay, but I told you now, for a high probable point of interest, there needs to be liquidity resting below that. Okay, now in this above that. Okay, now in this case there needs to be liquidity resting above that. Now look at this. Okay, if we choose this, okay, if we choose this order block right here, where is the liquidity resting underneath that? See that? There is no liquidity. But just think of this high right here. Okay, this is a swing high. We know that above every single swing high there are buy stops. Okay, there are buy stops, and then this was the high that took out liquidity. Okay, which means this was the move that was created, like this was originally created by the market makers. This is just an inducement. Okay, this is an inducement, which means why? Because the smart money traders have been taught to choose the order block that broke major structure. So they are going to look at this. Okay, they are going to choose this, and then the breakout traders and all of them, what are they going to do? They'll say this was the high that broke the structure, so they will have a buy stop above this. Okay, thinking that this is a strong high. Okay, and then even smart money traders would have their stop loss above this high. So what are they doing with this high right here? With this high right here, they're feeding liquidity into this point of interest. Okay, they're feeding liquidity into this point of interest, and then we might have an order block, something like this. Okay, now this is a point of interest. Remember that. Okay, this can be an order block, this can be an imbalance. Okay, this can be anything. So then price might come back up and give a little reaction like this. Okay, price might give a little reaction, and then okay, like more and more people would jump into this, like that same example I told you, like the first one. Like some might even see this as a trend line for me. Okay, now all of this is liquidity. They're inducing. Okay, they're feeding liquidity into this point of interest, and then price might go back up. We'll take out all of the stop losses. Okay, we'll take out all of the stop losses from all of these sellers. Okay, and activate the buy stops, and then boom, we'll come back down. Okay, this is the second example. This is now in this case, this is the entry we should always look for. This is the entry we should always look for, like this. Okay, I hope that's clear. Now, is there anything unclear about this? No, right? Okay. Then this will be example number 3. Okay, in that first example, I told you something like this may happen. Okay, price will come back up into this breaker block, support turning into resistance, and then we'll have another breakout structure. Okay, in that first example, I told you, do not look at something in here because it's not high probable. This high is a pool of liquidity. So look for something above that. That's what I told you. Okay, but the thing is, okay, we need to pay attention to how price is retracing towards that order block. Okay, let's say price is coming back up like this. What's that? That's compression. See, they're like tight price action, sideways price delivery, which means now be like the banks are stacking up orders. See that? Now, what do we have below this order block? We have equal highs. We have liquidity. See that? We have liquidity. We have liquidity, which means now remember, we need to choose the order block. Okay, that is closest to the inducement. Okay, the closest one to the inducement is what we're going to choose. Okay, now for this equal highs, we know these equal highs are liquidity. We know equal highs will be taken out. Okay, equal highs will be taken out. So we need to choose the closest order block. Okay, the closest point of interest. Now this, okay, now if this is to be ran out, if this liquidity should be taken out, okay, this is the closest order block, not this. Okay, so now we are no longer interested in this, we're interested in this. Okay, so this is what would happen. Price will come back up and then give a good reaction. So what I would personally do is, if I get this entry, okay, I will take my partial profits somewhere around here and then put it to break even, because the reason is, okay, because the reason is this order block is high probable too, and this high was an engineered high. Okay, this was an inducement. Okay, this was created just to like trap people. Okay, because why? Now some might even look at this as a trend line forming and all of those. So there are still chances of price doing this, going back up and then falling back down. Okay, there are still chances of price doing this. Okay, so if you now remember, if you get this entry, put it like, take your profits, put it to break even, and then patiently wait, because if price goes back up, now you've taken out your profits, so it will be just a break even. Then you know where to enter. Once again, you're going to enter as soon as price trades above this high. Okay, can you understand that? Hope that's clear. And then, okay, that was example number 3. I hope it's clear. Okay, I hope that's clear. And then this will be in a bullish market. Okay, so now for us to consider it as a strong low, price has to do this. Price has to take out liquidity from this low and then break structure. Okay, it has to take out liquidity and then break structure. See, it took out liquidity from this low and broke structure. Then price will come back down, come into this breaker block, and then go back up once again. Okay, we'll go back up, breaking another level of structure. Okay, so now, like I told you, we might have 2 or 3 order blocks, one right here and another one right here. Now, which one will everyone choose? All of them are going to choose this. Okay, everyone is going to choose this because the reason is, okay, this was that last lower high. See, I'm sorry, higher low. This is the low, this is the high, this is the higher low, and then this is the higher high. Okay, so everyone will start looking at this. Okay, like they do not expect this to break because why? They will think that this is the last higher low, and if this breaks, it will be a break of structure. Okay, so that is the inducement. Okay, they are showing you something false. They are making you trust this low for no reason. Okay, they are making you trust this low. Then what happens is, okay, I told you this is where most of the traders would enter the market because why? We will have a breaker block right here. This is where smart money traders would enter, and this is where this is a flip zone once again, a broken resistance turning into support. Okay, this is a break and retest once again, break and then retest. Okay, break and retest, and the breakout traders, what have they been taught? If price breaks structure and if it comes back down and breaks structure once again, they will view this low as a strong low. Okay, and they will have their sell stops below this low. That is what they're going to do. And then, like I told you, okay, now in this case, for it to be a high probable order block, there needs to be liquidity resting above that. Okay, now see, if you choose this order block, there is no liquidity resting above that. See that? There is no liquidity resting above that. So we have no reason to look at this order block. Okay, so what we do is we rather look for something below that. Okay, we have this. And why is this high probable? Because this low is a pool of liquidity, and this low was created. Okay, this low was created on purpose to feed liquidity into this point of interest. Okay, now this has so much of stop losses, this has so much of sell stops. We have like there are so much of orders resting below this low. Okay, so what happens is something like this. Price will come back down and give a good reaction. Okay, will give a good reaction. So like more and more people would jump into the trade. Now let's just assume that this was a 4-hour time frame, something like that. Let's like a 4-hour time frame. Okay, so on a lower time frame, this would happen. Something like this would happen. Okay, a break of structure to the upside once price hits this. So once they see that break of structure, they'll use that as a confirmation. That is what many traders do. They will use that as a confirmation and then look for a tiny little order block on a lower time frame to reduce their risk, and then they'll want to buy somewhere around here. Okay, but I told you now this was not high probable. Okay, some might even look at this as a trend line for me. Now all of this is engineered liquidity. Okay, all of this is engineered liquidity. So price might come back down and give a good reaction, something like this. Okay, might even give a good reaction. But now what are they doing? What are they doing? They're inducing. Okay, they are creating liquidity. Okay, this is engineered liquidity, and then price might come back down. Okay, so once this happens, this is the entry we should always look for. Okay, this is the entry we should always look for, because why? They're taking out all of these stop losses. Okay, they're taking out all of these stop losses and then activating these sell stops from this low, and then boom, we'll go back up. Okay, this is what happens. This is what happens every day. Okay, like I'll show you examples once we get into the charts. So, but remember, this is what happens all the time. Okay, this is what happens all the time. Price will come back down. We'll take out all of these stop losses, activate the sell stops, and then go the opposite direction. Okay, so this is the entry we should always look for. Targeting this high right here. This high right here is what we target. Okay, this is what happens. So I hope this is clear. It's clear, right? Hope that's clear. Then this is example number 1. This will be example number 2. Price can do something like this. Okay, something just like this. Okay, so now what have the smart money traders been taught once again? Okay, choose the order block that broke structure. Choose the order block that broke structure. So many people are going to look at this order block. Okay, like no one is going to look at this. Okay, most of them are going to look at this order block right here. Okay, like I told you for a high probable point of interest, there needs to be liquidity resting above this. Okay, so now does this have liquidity resting above it? See, there is no liquidity. Okay, there is no liquidity, but smart money traders, what are they going to do? They'll have their buy limit right here, and no one will have their stop loss below this low. Everyone will have it below this low, because or else the risk to reward will like reduce. Okay, see, now it's a 1 to 2. If they put it here, that's a 1 to 5. Okay, so everyone will put it below this low. Okay, but I told you for high probable point of interest, there needs to be liquidity resting above that. Okay, so now see, this right here is an engineered low. Okay, this is a trap. This is a like this is something false. Okay, an inducement. So we're not going to look at this. We're going to look for something underneath that. Okay, something around here. Then price will come back down, give a tiny little reaction. Why do something like that? Okay, why? Then more and more people would get into the trade. Okay, more and more people would get into the trade. Then price will come back down. Will take out all of the stop losses, activate the sell stops, and then go back in the opposite direction. Okay, this is what happens. So in this case, this is the entry we should take. Okay, this is the entry that we should look for. Okay, I hope that's clear. This is the entry we should look for. Now, don't worry, I'll show you chart examples, then everything will be clear. Okay, this is the entry we should look for. And then this is the final example. Price can do something like this. Okay, we'll break structure and then come back down into the breaker and then go back up once again. Okay, we'll go back up once again. Okay, in that first example, I told you, do not look at this order block right here. Okay, don't look at this order block right here. That's what I told you. Okay, rather look for something below that. Okay, that is what we're gonna do. But now the thing is, okay, now the thing is we need to pay attention. We need to pay attention to how price is retracing. Okay, how price is retracing. Now let's say price is coming back down like this. See that? That's sideways price delivery. Okay, tight price action. See that? Okay, so now what do we have? We have liquidity resting above this order block. See, we have equal lows. We have equal lows above this order block. Okay, we have equal lows above this order block. So I told you we need to choose the order block that is closest to the inducement. Okay, the closest one to the inducement. So now, what's the closest one to this liquidity? It's this, not this. Okay, so now personally, what I would do is if I get a trade from here, I'll have my stop loss below this. Okay, price will do this, something like this. So if as soon as price gives this reaction, I'll put it to break even and then take my profits. Okay, I'll take partials and then patiently wait. Because why? I know that this low right here was an engineered low. So this there are still chances of price doing something like this. Okay, price can do something like this. So now this we can, now it's about taking the risk. Okay, like now let's just not come here. It just tapped here and then went back up like this. Okay, then like what if he wait for price to come here and it reverse You can hear me, right? I hope you can hear me. Start recording once again. That's what I said. There's some problem with your connection. That's the thing. Okay, so I hope you can hear me. Okay, did you start recording? Okay, you started recording, right? Okay, so this is that last example. Okay, okay, this is that last example. Okay, I hope this is clear. Okay, pay attention to how price is retracing towards that order block. Okay, now see, well, like this in the first example, this wasn't high probable. Okay, this was not high probable because the reason is there was no liquidity. But I told you we need to pay attention to how price is retracing. Let's say price is doing something like this. What's that? Compression. Okay, sideways price delivery. Okay, we have, now what do we have? We have equal lows resting right above our point of interest. We have equal lows, which means I told you to choose the order block or choose the point of interest that is closest to the inducement. Okay, the closest one to the inducement. Then this is the closest one, not this. So now personally what I would do is if I get this entry, okay, I will put it to break even and then take my partials very soon. Okay, because the reason is there is still chances of price coming back down, taking out all of these lows and then tapping into this. Okay, so it's about taking the risk. I would take both. Okay, if I take this, I'll put it to break even and then take my partial soon because there's still chance of price coming back down, tapping into this and then going back higher. Okay, I hope the examples are clear. It's clear, right? Now these are the patterns that we use for entries. Okay, these are the patterns that we use for entries. And you know about market structure, right? The classic market structure, like how it goes: higher highs, higher lows, higher highs, higher lows. That's how the uptrend goes, and the downtrend it's like this. Okay, but how is it formed? Okay, how is it formed? Now this is the thing. Okay, now we're going to talk about trading ranges and market structure both together. Okay, price can do something like this: higher highs, higher lows, higher highs. Okay, and we had a break of structure right here. We had a break of structure. Okay, so after a break of structure happens, okay, after a break of structure happens, a new trading range will be created. A new trading range will be created. Now our trading range is from this low right here to this high right here. That is our new trading range. Okay, that's our new trading range. So what do we do when we find out a new trading range? We look for discount and premium prices. Have you heard of discount and premium prices? I hope you have. Yes, okay, you heard of discount and premium price. So what do we do? Okay, what do we do? Once a trading range has been created, okay, we look for discount and premium prices like this, from this low right here to this high right here. So now since we are in a bullish market, we have to wait for price to get into these discounted prices before going back higher. Okay, we have to wait for price to get into the discounted prices before going higher. Okay, because the reason is, like, if you want to buy something, we have to wait until prices reduce. Okay, and then give me a minute. Okay, and then have you heard of internal range liquidity and then external range liquidity? Have you heard of that? Okay, let me know, or else I'll explain it to you. Have you heard of internal range liquidity and then external range liquidity? Have you heard of that? Okay, so I'll tell you what it is. Okay, so internal range liquidity is the liquidity that is resting inside of this trading range. Now from this low to this high, this is a trading range, and then anything inside of this is internal range liquidity. Now let's just assume that this is a 4-hour time frame. How would the 15-minute go? Something like this: high highs, high lows. Like you, okay, you okay, I'll teach it to you. Okay, I'll teach it to you. It's like this. Now the current trading range is from this low right here. Okay, from this low right here to this high right here is the new trading range. Okay, this is the new trading range. This is the dealing range for us. Okay, we're dealing inside of this trading range. So whatever the liquidity that is resting inside of this trading range, okay, that is internal range liquidity. Okay, because it's like this: Okay, now let's just assume this is a 4-hour time frame. So how would the 15-minute go? Something like this: higher highs, higher lows. This is how the lower time frame would go, right? This is how the lower time frame would go. Okay, then all of these lows will act as internal range liquidity. Okay, all of these lows will act as internal range liquidity, because why? I told you, below every single swing low there are sell stops. There are sell stops. So this low right here has sell stops, this has sell stops, this has sell stops, and this has sell stops. Okay, all of that are internal range liquidity. Okay, all of that are internal range liquidity. So price is coming back down into a discounted price to take out the internal range liquidity that is resting inside of this trading range. Can you understand that? Okay, that is internal range liquidity. Okay, the liquidity that is resting inside of the current trading range. Okay, and then the liquidity that is resting outside of the trading range is external range liquidity. Okay, now where is the external range liquidity? Right here. Okay, it's outside of the trading range. This is the current trading range. Okay, and the liquidity that is resting outside of this is external range liquidity, which means there are buy stops resting above this high. Okay, so what they do is they'll come back down to take out internal range liquidity, and then after taking that internal range liquidity out, they will go after external range liquidity. Okay, external range liquidity, because why? This is a swing high and there are buy stops resting above every single swing high. Okay, so remember, we should always enter at internal range liquidity. Okay, enter at internal range liquidity and then exit at external range liquidity. Let's just assume that we entered from somewhere around here. Okay, so this is where we exit. Okay, this is where we exit at. Okay, this is where we take our profits. This is the safest target. This right here is the safest target. Okay, this right here is the most safest target. Okay, if you get a, remember, we should enter at internal range liquidity and then exit at external range liquidity. Okay, hope that's clear now. Okay, that is about internal range liquidity and then external range liquidity. And then now how will a trading range be created? Okay, how will a trading range be created? That's the thing. Okay, so we can say something like this: price has now come back down. Price is now in a discounted price, because why? Our trading range is from this low to this high. That's our new trading range. Okay, so if we draw the discount and premium prices, we are now in a discounted price. Okay, and price has taken out internal range liquidity. And then what is, like, after taking out internal range liquidity, where will they go next? They will go after external range liquidity that is resting above this high right here. Okay, the external range liquidity that is resting above this high. That is what they would. That is their next area of target. Okay, this is where they target next, because like I told you, they will go in search of liquidity. Okay, because liquidity is what drives the market. Okay, so now after coming back down and taking out this internal range liquidity, this is the area with external range liquidity above this high. Okay, so now for us to consider it as a new trading range, okay, price has to do this. Okay, the lower time frame has to do this. Now, like I told you, let's just assume this is a 4-hour time frame. Okay, then the lower time frame will go like this, right? This is how the lower time frame would go. Okay, so now for us to consider it as a new trading range, okay, it has to take out this external range liquidity, and then intermediate term structure, or as this lower time frame structure, has to break to the downside. Can you understand that? Okay, the external range liquidity has to be taken out, and then the lower time frame has to break structure to the downside. Only when this happens, we are going to say this is the low of the trading range, and then this is the high of the trading range. Okay, so this is a trading range now, from this low right here to this high right here. Okay, like it has to take out this external range liquidity, and then lower time frame has to break structure to the downside. Okay, I hope that's clear. Now let's just say it did not break structure to the downside, even though it took out liquidity. See, now it's still going. It's still going. See that? No structure is been broken yet. So we cannot say from this low right here to this high is the trading range. We can't say from this low to this high is the trading range, to this high to this high. We can't say that. We have to wait until the lower time frame breaks structure. So let's say price did this. Boom. Okay, now we have a trading range. Now we have a trading range from this low to this high. Now this is our current trading range. Okay, the lower time frame has to break structure. Only then we can look for discount and premium prices like this. Okay, I hope it's clear. Is it clear now? Okay, good. And the next thing is, let's just say that price is going back up like this. And then before taking out this external range liquidity, out, if price breaks structure to the downside, we cannot say that this is the low of the trading range and this is the high of the trading range. Okay, we can't say that because why? Now this is the draw on liquidity. Okay, this is the next area with liquidity. Now they failed to take that high out, which means we cannot say from this low to this high is our trading range. Okay, because if this happens, okay, now remember, this low was supposed to create a higher high. Okay, it was supposed to create a higher high. So if it wants to create a higher high, intermediate term structure cannot break. Now, if it breaks to the downside, this is a failure swing. Okay, this is a failure swing because this low was supposed to create a higher high, but it failed. See that right here, this low failed to create a higher high, which means now this becomes a weak low. Okay, this is when it becomes a weak low. Then we should look for something underneath that, not anything inside of this. Okay, now this has turned weak. We have to look for something below that. Okay, we have to look for something below that. Then price can do something like this. Come back down. We'll take out stop losses from this low. And then now price will go back up like this. Okay, I hope it's clear. Now our trading range is from this low right here to this high right here. Now see, this is why market structure is so messy. Okay, it's playing around. So now our trading range is from this low to this high. I hope that's clear. Is it clear? This is how we get a new trading range. Okay, let me know if there's anything unclear. Okay, so this is how we get a trading range. Now in a bullish, this is a bullish market, and then this is a bearish market. Okay, this is a bearish market. This is what price would do. Lower lows, lower highs, lower lows, lower highs. That's how price would go. We have a breakout structure. Okay, so our trading range is from this high right here to this low right here. That's our new trading range. Okay, that is our new trading range. and then now price came into a premium price. See, before selling, price has to go into some higher price. Okay, see that now price is in a premium price. Okay, it's in a premium price. So now the thing is, before falling back down, it has to go into a premium price. And why is it going there? To take out internal range liquidity, the liquidity that is resting from this high right here to this low right here. That is the internal range liquidity. So after taking this internal range liquidity out, so what's this internal range liquidity? Now, see, suppose this is the 4-hour time frame. This is how the lower time frame would go. Something like this. So all of these highs will have buy stops resting above that. So that is the internal range liquidity. Okay, that is the internal range liquidity. So we should enter at the internal range liquidity and then exit at external range liquidity. If we enter somewhere around here, this is where we take our profit set. Okay, I hope that's clear. And then, like I told you, okay, this is the internal range liquidity. And then after taking that out, where are they coming next? They're coming to take out the external range liquidity that is resting below this low. So now for us to consider it as a new trading range, price has to do this. It has to take out this external range liquidity from this low right here, and then intermediate term structure has to break to the upside. Okay, it has to complete this draw on liquidity, and then intermediate term structure or the lower time frame structure has to break to the upside. Okay, it has to break to the upside. So if this happens, we can say this is the low of the trading range and this is the high of the trading range. Okay, this is our current trading range there. Okay, and we look for discount and premium prices. Once again, it's the same thing. We'll have to wait for price to get into a premium price. Okay, I hope that's clear. Now this is how we determine a trading range. And then now let's just say price did something like this. Price is coming back down, and then before taking out that external range liquidity, now price has broken structure to the upside. See that price has broken structure to the upside. So we can't say our trading range, our new trading range is from this high right here. Okay, from this high right here to this low right here. We can't say that because why? Price failed to take out this low. Okay, this high right here was supposed to, okay, this was supposed to create a lower low. Okay, this was supposed to create a lower low, but it failed. See that this is what we call a failure swing. So then this becomes a weak high. This becomes a weak high. So then we have to wait until price takes that out and then look for something above that. Something right here. Okay, then price can do something like this. Tap and then fall. Okay, then now our trading range is from, okay, now our trading range is from this high right here. Okay, from this high right here to this, wait, give me a minute, to this low right here. Okay, this is our new trading range. Okay, all of this inside of this is, now this is just noise. Okay, this is just noise. So many traders, they might like get confused in somewhere around here. Now this is a complex pullback kind of thing. Okay, so I hope this is clear now. This is how we determine the trading ranges. Is it clear? Okay, then now let's get into the charts. Okay, let's get into the charts. Okay, so now as intraday traders, okay, now you're interested in intraday trading, right? Or is it swing or intraday or what's it? What's the style like you prefer, intraday or short-term trading or swing trading, scalping, or what's that? What's the thing you want to know? Is it intraday? Okay, let's just say you're an intraday trader. Okay, so now for intraday traders, okay, most people say that the 1 hour is the most important time frame, or the 4 hour, or the 30 minute, the 15 minute, the 1 minute, or the 5 minute. That's how they think. Okay, but no. Okay, like no matter what type of a trader you are, okay, no matter what type of a trader you are, you must always start with the higher time frames. Okay, by higher time frames, I mean from the weekly. Okay, like the month, like you can even start from the monthly, but the monthly does not show a lot of details. Okay, so I wouldn't start from the monthly. I would start from the weekly time frame. Okay, I'll start from the weekly time frame. And this is how I would do. Like I'm not concerned about any of these. Okay, because the reason is we are intraday traders. Okay, price might take another couple of years to get into these areas. So like I don't care about what happens. Okay, the only thing that I'm concerned about in the weekly time frame is this. Okay, where are we currently at? Okay, where are we currently at? Let's just say we were right here. Okay, like where are we currently at? Okay, that is what we're expecting. Where are we currently at? Okay, so now look at this. This is how price went. Higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, breakout structure. See that we have a breakout structure now. On the weekly time frame, we have a breakout structure. Price, what did price do? Took out liquidity from this high right here. Okay, it took out liquidity from this high. Okay, took out liquidity from this high and it broke structure. And it broke structure. See that? Okay, which means now we have a breakout structure. We have a breakout structure. Okay, because now what? There are two types of trades. Okay, the one is continuations. This is continuations. Okay, simple. And the other one is reversals. Okay, the other one is a reversal. So now this right here is a reversal because why? We were bullish and then now price has turned into a bearish market. Okay, can you understand that? Price now has taken liquidity from this high. See that? Just a little wick above that. Okay, like why are they doing that? Look at this. Okay, why are they doing this? Just a little wick above this. Okay, they will go back up, shoot back up, and then they will activate the buy stops that are resting above this high. There are buy stops that are resting above this high. So they will take out these buy stops, and after taking out buy stops, simple, where are they going next? They're coming after sell stops. Okay, after taking out buy stops, they will come after sell stops. Can you understand that? I hope it's clear. Let me know if yeah. Okay. So then on the weekly time frame, okay, our current trading range is from this high right here to this low right here. That's our current trading range on the weekly. Okay, on the weekly, that is our current trading range. Then what we do is we look for discount and premium prices. Simple. From this high to this low. Okay. And we know that if price wants to like sell back, once again, if they want to sell back down, okay, they have to go at least into a premium price before falling back down. They have to go at least into a premium price, at least into this equilibrium. Okay, at least into the equilibrium before falling back down. So let's say, let's just remove this 0 and 1. Okay, price, we know that now price has to pull back until at least to this equilibrium before falling back down. And the next thing I look for on the weekly is like what is the market intention? Okay, what is their intention? So which means like, what do I mean by intention? Now price has taken out sell stops, right? Price has taken out sell stops from this low. See, they activated the sell stops and now they're pulling back up. Okay, so now the thing is, after taking out sell stops, where will they go next? They will go after buy stops. Simple. Okay, from sell stops to buy stops, from buy stops to sell stops. That's how they would go. So after taking these sell stops out, where will they go next? They will go after buy stops. So then let's go to a daily. Now we know their intention right now is to go after the buy stops. Okay, we know that. Then let's go to a daily. Now once we get into the daily, now this is the current trading range on the higher time frame, from this low right here to this high right here. Okay, to this high right here. That is our current trading range. Okay, I hope that's clear. This is our current trading range, and then this is the equilibrium level. This is the equilibrium level. Let's delete that for a while. Okay, now we studied from the weekly time frame that price has taken out the sell stops. Okay, price has taken out the sell stops, and then we know that their intention is to go after buy stops. So then where are the buy stops? Okay, buy stops are the internal range liquidity from this high to this low. Okay, all of these highs are internal range liquidity, and these have buy stops. This has buy stops above it. This has buy stops. See, this swing high, it has buy stops above that. These highs have buy stops above that. See that? I hope it's clear. Okay. Now what is their intention now? To go after buy stops. So simple. Okay, now see, this is the advantage of coming back down from a higher time frame. Okay, so now we know that these highs will be taken out. This high will be taken out. This high will mostly be taken out. Okay, this high will most likely get taken out. Okay, we know that. Okay, but now let's just say, okay, we're targeting these highs now because we know where price wants to go. Now this is how we get the directional bias. Okay, so is it clear so far? Is it clear what I told you so far? Okay, so this is how we get the directional bias. Okay, because when price is here, okay, when price is here, we don't know actually where it wants to go. Okay, now if you're not from the higher time frame, if you're not coming back down from a higher time frame, we do not know what it wants to do. But now we know that price is pushing higher to take out these buy stops. Then if we go to a lower time frame, to a 4 hour or something, you see, this is how we do a top down. Okay, this is how we do a top down. And then what has price done? Okay, what has price done? Now we know that these highs, okay, these highs will have buy stops resting above that. Okay, we will have buy stops resting above that. And look at this. Okay, what has price done? It took out liquidity from these equal highs. See that? Took out liquidity from these equal highs and then broke structure. See that? Broke structure. See, it pushed back up, took out liquidity, broke structure, came back up. What's that? Inducement. See that? We have equal highs. We have equal highs, and then let's delete this for a while. Now I told you, if you remember how we consider it as a strong high, it has to do this. Price has to take out liquidity and then break structure. Simple. That's why I told you. It has to take out liquidity and then break structure. If this happens, this high will be considered as a strong high. Okay, so that is exactly what happened. See that? Took out liquidity from these highs and broke structure, which means this is a strong high. And if you remember that first pattern I told you about, it's this. Takes out liquidity, okay, like this, then breaks structure, comes back up. What's that? Into the breaker, falls back down. Then what's this? This is the inducement. This is the inducement. We have to wait for this to get taken out and then look for something above that. Okay, we're not going to look at something right here because why? This was the engineered liquidity. This is the inducement. Okay, this is the inducement. Then that is exactly what happened. Look at this. Okay, what did price do? Took out liquidity, broke structure, came back up. See, I told you it comes into the breaker. Now this is the breaker block. See, price came here. Okay, came into this point of interest. Look at these weak rejections. Okay, because why? This is a flip zone. This is a flip zone. See, broken support. This was a previous support. Broken support turning into resistance. See that? See, all of these weak rejections. Once they see this bearish engulfing candles, they will sell here. Stop loss above this high, which means there will be stop losses resting above this high. Okay, and now this is equal highs. Okay, this is something like a resistance. So what do? We look for this. Now this order block is high probable. Can you understand that? I hope it's clear. Okay. Now this order block right here, okay, this order block right here is high probable. Reason is there is liquidity resting below that. See that there is liquidity resting below that. That is the reason why this order block is high probable. Okay, so now we have the directional bias. Okay, so if you go to the weekly, now like why am I telling you to start from the weekly? Because we are intraday traders. Okay, the only thing we need to know is what will the next weekly candle do? Will it go up or will it go down? If you get a bias for just one single weekly candle, okay, one single weekly candle, you have the bias for the whole week. Okay, for the whole week. Now if you're saying it's gonna go up, you have to find reasons why. If you're saying it's gonna go down, you have to find reasons why. But now since we know that price has taken out these sell stops, we know the next weekly candle will most likely go up to take out these candles. Okay, to take out these buy stops. Then let's go to a 4-hour. Okay, then now we have a bias. See that? Now we have a bias. So every time price pulls back down, we're buying from here. Then goes back up. Every time it pulls back down, we're buying once again, like this. Every time it pulls back up, we're buying. We're buying. Okay, can you understand that? Okay, this is what we do. This is what we do. Now let's just say we were right here. Let's say we were right here. Okay, then what should we do? We have these equal lows. See that? We have equal lows. Okay, you can understand these liquidity concepts, right? Equal lows and equal highs thing. Okay, so we have these equal lows, which means this right here is a pool of liquidity. So what should we do? We know that these equal lows will be taken out. We know equal lows will be taken out. So what should we do? We should look for an order block below that. See that? We have this now. We have this order block. Can you understand that? We have this order block right here. And what makes it high probable? Okay, what makes it high probable is this liquidity resting above that. See, I told you, for a high probable order block, for a high probability order block, there needs to be liquidity resting above that. Can you understand that? Now we have liquidity resting above this order block. Above this order block, we have liquidity. Because why? We know equal lows will be taken out. We know equal lows will be taken out. Okay, so where will the manipulation can come into? This is the closest one it could come into. Can you understand that? Hope it's clear. Let me know if there's okay. And then we can refine this. Now this is, now remember, this is just a point of interest. Okay, we are not going to buy as soon as price taps into this. We're not going to do this. Okay, we're not going to do this. Okay, we will wait until price like give us a reaction. We'll wait until price like for more confirmation. Okay, so this is what we're going to do. We'll have this marked. Okay, let's have this marked, and then once price comes into this, we will go to a lower time frame. Let's say to a 15-minute. Okay, now when we go into a 15-minute, what can we see? What can we see? Okay, now price has taken out liquidity from these lows. See, price has taken out liquidity from these equal lows, and then now price is inside of a 4-hour order block, a 4-hour high probable order block. Okay, and then see, now this is where the daily lows were taken out right here. Okay, it was taken out right here, but see, it did not break structure. This high is protected, this high is protected, this was protected. But what happened? As soon as price taps into this 4-hour order block, broke structure. See that? It broke structure. Can you understand that? Okay, now on the 15-minute, we have a break of structure. Okay, we have a break of structure on the 15-minute right here. Okay, now remember, price is fractal. Okay, price is fractal, which means like whatever happens on a higher time frame will happen on the lower time frames. Okay, because time doesn't know price and price doesn't know time. Okay, whatever happens on a higher time frame will happen on a lower time frame. Okay, so it's the same thing. Now it's the same thing. See, I told you, for us to consider it as a new trading range, price has to take out external range liquidity and then break intermediate term structure. See that? What did price do? Went like this: higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs. What's that? Breakout structure. See that? We have a breakout structure. Then on the 15-minute, we have a breakout structure and we have a new trading range on the 15-minute. What's the new trading range? From this low right here to this high right here. Can you understand that? Okay, that is our new trading range on the 15-minute. Okay, on the 15-minute, this is our new trading range. Then what do we do when we get a new trading range? We look for discount and premium prices. Simple, like this. Okay, and we know anything below this level is a good price for us to buy from. And then I told you, okay, price will come back down into a discounted price. Like, why are they coming back down? To take out internal range liquidity. And then where is the internal range liquidity? Internal range liquidity is resting below all of these swing lows. All of these swing lows. Can you understand that? Okay, I hope everything's clear. Yeah, and then see, look at this. Okay, this was that last swing low in a discounted price. So we have to wait for that to get taken out because that was the last swing low. Okay, that was the last swing low. And then see, look at this. This is the last push down before the push up. Last push down. See, last push down before the push up. Can you understand that? Okay, so we can easily do this. Okay, we can easily do this by limit right here, stop loss below this low, but stop loss is too big for us. Okay, so now we can now see from now we're coming back down from the weekly to the daily to the 4-hour to the 1 hour, then to the 15-minute, and now let's go to a 1 minute. Now let's see what's happened. Okay, so now what did price do? Okay, what did price do? It took out liquidity from this low. Okay, took out liquidity from that lows. Okay, see that? It took out liquidity from this low and then tapped into the 15-minute point of interest, tapped into the 15-minute order block and broke structure. See that? Can you understand that? And it broke structure. Okay, it broke structure. Then what happened? What happened? Then we have a new trading range on the 1 minute from this low right here to this high right here. And we know that, okay, we know that this low right here is a strong low, because why? It took out liquidity and it broke structure. Can you understand that? Okay, so this is the new trading range on the 1 minute from this low to this high. Then we look for the high probable order block. Which one is the high probable order block? Not this, because why? Okay, we cannot look at this because there is no liquidity resting above that. But look at this. This is equal lows. See that we have equal lows, and then we have this order block right here. See that? Now remember, in these types of order blocks, okay, in these types of order blocks, the volume is in the body. Okay, the volume is in the body. So I'm not looking at this. I'll take it from here to this low. Okay, I hope it's clear. Can you understand that? Let me, okay. So then now look at that. Okay, we can easily do this. buy right here, stop loss below this low. See, now even though it was messing around, stop loss was never hit. Okay, the stop loss was never hit. But for me, what happened was, okay, I had a buy limit right here, stop loss below this low. Then what I did was, as soon as I saw this rally up, I put it to break even. Then price came back down, took me out at break even, and then pushed back up. Okay, but that's okay. Okay, even though it stopped me out at break even, like I do not have FOMO. I'm not gonna jump. Like I will not jump in on trades from anywhere around here. I won't do that. Okay, I will patiently wait because I know there is always another chance. Okay, now look at this. Price took out liquidity from this low. See, it took out liquidity from these equal lows, relative equal lows, and then broke structure. See that? Broke structure. Broke structure. So now if you remember the pattern, okay, if you remember the pattern, this is it. Takes out liquidity, breaks structure, comes back down. What's that? Inducement. Okay, this is the inducement all the time. This is the single pattern we're using. Then wait for price to come back down, buy. Buy below this. But as soon as this gets taken out, we buy. Okay, can you understand that? See, what did price do? Took out liquidity. Yeah, took out liquidity, broke structure, came back down. What's that now? It's an inducement. Okay, it's an inducement. Then we have to wait for that to get taken out patiently. Okay, we have to patiently wait for that to get taken out. Then I told you, choose the one that is closest to the inducement. Okay, the closest one to the inducement. So now what's the closest? Okay, we can't say this imbalance is the closest one. Okay, we can't say that. And not even this order block is also not the closest one. This is not the closest one. What's the closest one? See, this is where the whole push down started to take out this liquidity. See, this is where the push down started to take this liquidity out. Can you understand that? Okay, this is where the push to the downside started, like this. Okay, which means now on the lower time frame, on the 30 seconds, okay, I don't think they let me go back down that far. Okay, so on the 32nd, we had a breaker block right here. Okay, because this is the closest one. See, I told you choose the one that is closest to the inducement. Okay, so now see, this is the closest one to the inducement, not this order block or not this imbalance. Can you understand that? I hope that's clear. Let me know if it's not clear. It's clear, right? Okay. Now it's like this. Okay, it's like this. See, now what did price do right here? Now this is the inducement. Okay, this is the inducement because why? Took out liquidity, broke structure, came back down. What's that? Once it comes back down, the first move to the downside, that is the inducement. See, because why? Everything in the market has to make sense. Okay, there has to be some logic behind every single move in the market, because it has to either tap into an order block, it has to either come into a breaker block, or it has to fill some imbalance. Okay, it has to do something. Okay, it has to have some like logic behind it. But what is this doing right here? See, what is it doing? It did not even fill this imbalance completely. It didn't even tap into an order block. Okay, it didn't take out liquidity. It did nothing. Okay, it did nothing, which means if a move does not make sense, it is an inducement. Okay, it is an inducement. Simple. Okay, and then what is the closest point of interest to the inducement? Okay, what is the closest point of interest? It's not this order block. Okay, it's not this order block. Because why? Because why? Okay, there is something on top of it. What is this? This is where the whole push to the downside started. See that? This from this high, this was the swing high that created this push to the downside. Can you understand that? Okay, so on a higher time frame, this right here will be an order block. Let's see that. Let's go to a 3-minute. It's still an imbalance. Let's go to a 5-minute. No, we can see that. Let's say we go to a 2-minute. No, it's not clear. Okay, let's just stay in the 1 minute. Like what I'm trying to tell is this. Okay, now look at this. This is where the push to the downside started. Can you understand that? See, this is where the push to the downside started to take this liquidity out. Okay, to take this low out. This is where the push to the downside started. Can you understand that? not this. This is not the last push. Like this is where the whole push down started. Can you understand that? Okay, this is where the push to the downside started. Okay, it's very simple. Like there's nothing overcomplicated. Like this was the swing high that created this push to the downside. Let me know if it's clear. Okay, so then, okay, so if that happens, okay, there will always be a breaker block right here. Okay, this is what we call a breaker block. So that's why I told you, you need to know the smart money basics for this. So this is what we call a breaker block. Okay, so right here on a 30-second, there is a breaker block. So that is the closest one to this inducement, not this order block or not this imbalance. Okay, this is the closest one. So obviously you can do this. You can do this, no problem in that. Okay, but I would take only the breaker block. Okay, I will take only the breaker block because this is where the push down started. Then buy right there. See that? Look at that entry. Okay, you can easily be a buyer right there. Can you understand that? Hope it's clear. Okay, so we'll have a buy limit right here. Stop loss can either be below this low. Okay, that's not a problem. 4.8 pip stop loss, but I had it below this low. Well, okay, 2.6 pip stop loss, and then where am I targeting? Where am I targeting? The first target is the high of the 15-minute range. That's my first target right here. That's my first intraday target. Okay, can you understand that? Hope it's clear now. Let me know if it's unclear. It's clear, right? Okay, see now this is the first target. Okay, this is the first target, the intraday target, the 15-minute high. If we play price, boom. Okay, now we are taking partials. Okay, remember now this is only a target. This is our first target then. And since we are with the higher time frame, where will we target next? Where will we target next? I told you. After taking sell stops out. Okay, now remember this is our range from this high to this low is our weekly range. Okay, that's our weekly range. So after taking sell stops out, where will they go next? They will go after buy stops. Buy stops are above all of these swing highs, but this is a strong high and a high probable order block. Can you understand that? So then, like we will take partials from 45 pips. That's the intraday target, and then this will be the final target. See that? I hope it's clear. Can you understand that? This is why I told you to stay with the higher time frame. Okay, see, from the weekly we know that price wants to go up. So that is why we take partials from here, and then we leave a little runner. We leave a small lot size to run into these areas of interest. See that? Can you understand it? Into these buy stops. Okay, is it clear? Okay, so then that's what we do. Easy. See that? Now price is going back up. Simple. Boom. See, targets hit. Very, very simple. Okay, it's very simple. You have to wait for the pattern to occur on every single time frame. Okay, like we have to wait for the pattern to occur. That's the only thing we need to do. Okay, wait for that pattern to occur. Okay, see, now look at this. I'll show you another example. Okay, if you go to the 15-minute, and then okay, let's see what happened right here. Okay, what happened right here? See, price came back up, went back down, and then broke structure. See that? Broke structure. Okay, it broke structure, and then now how will the smart money traders, how will the retail traders, everyone would view this like this. Let's say we were right here. Okay, now look at this. Okay, now this is how people will say, the people who follow market structure: high highs, high lows, high highs, high lows, high highs, high lows. Okay, so then this was that last lower high, right? High highs, high lows. I'm sorry, this was that last higher low. Okay, so like I saw many people looking at this order block right here. Because why? And because why? This, now look at this. This has a huge imbalance. It took liquidity from these lows. Okay, so everyone was looking at this order block. Okay, but I told you for high probable point of interest, for high probable order block, there needs to be liquidity resting above that. Okay, there needs to be liquidity resting above that. So if you choose this order block right here, where is the liquidity? See that there is no liquidity resting above that. Can you understand that? Okay, there is no liquidity resting above that. Okay, and remember, these clear order blocks are always traps. Okay, the clear order blocks are always traps. Most of the time they are traps. Okay, because the reason is, like, many people trade using smart money concepts. Okay, this might even be called as a demand zone. Okay, all of those. Okay, so now many people will look into this order block, because why? They do not want this to break, because this is the higher high and this is the higher low. Okay, then this is what most of the traders would do, like this, stop loss below this low. But I told you, okay, for high probable point of interest, there needs to be liquidity resting above that. So now we know that. Now look at this, and I told you about the breakout traders. If price breaks structure, okay, if price breaks structure, if it comes back down and breaks structure once again, okay, and breaks structure once again, they will view this as a strong low. So what do they do when they find out a strong low? They will place their sell stops below this low. Okay, they'll have their sell stops below this low. That is what they're going to do. Okay, so which means this low has turned into a pool of liquidity. Can you understand that? Okay, this low right here has turned into a pool of liquidity. Okay, so we are not going to look at this. We will look for something below that. See that? We'll look for something below that. We will patiently wait for this to get taken out. Okay, we will patiently wait for this to get taken out. Okay, and let's just mark this too. Okay, now look at this. This is where everyone else would enter. This order block is where everyone else would enter, but this is where I would enter the market. Okay, this is where I would enter the market. So let's refine this. Let's refine this. Let's go to a 1 minute. Then see this. Okay, see, then we can refine it down to this beautiful order block right here. Can refine it down to this, stop loss below this low. And the thing is, okay, I told you, now this was that 15-minute order block, the false order block, okay, the fake order block. See what happened? Price tapped into that order block, and see, it gave a break of structure on the 1 minute. See, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, break of structure. See that? Price broke structure. So now more and more people would jump into this trade, because they'll think now this is confirmed, because it tapped into this order block and broke structure. Now more and more people would jump into this trade. Okay, see, now this is engineered liquidity. This was a false breakout structure. Okay, then we have to patiently wait for all of that to get taken out. So what are we going to do? We will have our buy limit right here, stop loss below this low. Okay, and this will be the first target. Okay, this will be the first target. Can you understand that? Okay, this will be the first target, and then we will take up like 80% of the profits from here. And then what's the next target? We know where price wants to go. This will be the last target for us, the equal highs on the 4-hour time frame. And then see what happened. Oh, tapped. Look at that. Okay, see how it tapped you only with a week. Okay, just with a weekend. Like, I got all of these entries. Okay, if you go to my channel, you can see all of these entries. And then see what happened. Now it's going. Boom. Okay, now it's going. See, now I told you to take partials from here. Okay, like if you close everything from here, okay, like you're wasting your lot size also. Because why? We know that price wants to go into this area. So why not hold it until then? Okay, take your partials, pay yourself right here, and then leave a runner. See that? See, now just think that you, as an intraday trader, you took all your profits from here. Okay, you took all your profits from here. Then like you will like regret it a lot, because see that move after that. As soon as price breaks above that, see, now we will hold it. We'll hold it until there. Okay, can you understand that? It's the same thing. It's the same thing again and again that's happened. Okay, I hope it's clear. Yeah. Okay, so now is everything clear so far? What I told you, it's clear, right? Like everything I told you so far about the top-down analysis, like how we got the bias and all of those, it's clear, right? Like how we got the bias, how we got the entries, how we refine the points of interest and all of those, what we do in the 1 minute, what we do in the 15-minute, everything is clear, right? Let me know if anything's unclear. Okay, so I'll show you more examples. Okay, I'll show you more examples. Now you have the session recorded, right? You're recording the session, right? Okay, okay. Or else, or else you have nothing to watch later. Okay, now look at this. Okay, now it's the same thing. Okay, see, it's the same pattern. Okay, it's the pattern that you should keep in mind. Nothing else. Okay, now nothing else. It's the pattern that you should keep in mind. Let's say, yeah, right here. Okay, look at this. What did price do? Took out liquidity from these highs. Okay, took out liquidity from these highs and broke structure. Okay, took out liquidity from this high and then broke structure, which means this high right here is a strong high. This high right here is a strong high and then came back up. What's that? Remember the pattern now. Takes out liquidity, breaks structure, comes back up, inducement will go back down. When it starts coming back up, wait for this to be taken out, sell. That's the pattern. That's the pattern. Okay. So what happened? Took out liquidity, broke structure, came back up. What's that? That's the inducement. Okay. Short term high inducement. Then came back down. This is where intermediate term structure broke to the upside. So which means this is the low. Okay. Now this is the trading range from this high right here to this low. That is our new trading range. Can you understand that? Okay, that is our new trading range. Then what we should do is we should look for a point of interest above this inducement. Okay, look for a point of interest above this inducement like this. Okay, and remember this is just a point of interest. Okay, this is just the point of interest. We are not gonna sell as soon as price taps here. We're not going to do this. Okay, we are not going to do this. Okay, what we're gonna do is as soon as price gets here, price gets into this areas, we'll go to a lower time frame. We'll go to a lower time frame and then see what price did. Okay, see what price did. Price took out liquidity from this high right here. See that? Took out liquidity from this high and then broke the low that created the high. Okay, this was the low that created this high. So broke that. See that? Broke that low. And then what's this? What's this? Simple. That's the inducement. See, this is that second example I told you about. Okay, this is that second example I told you about. If you remember that, okay, this is that second pattern. Okay, this is that second pattern. See, took out liquidity. Okay, took out liquidity. This is where structure got broken. Okay, this is where structure got broken. So everyone will look at this. Everyone will look at this. Okay, then I told you this is not high probable. This is not high probable. Okay, so we have to wait for that to get taken out. Can you understand that? Hope that's clear. Okay, and then we have this 15-minute last push up before the push down. See that? Because this is the swing high. See, this is the most highest candle like in this range. Then we do this, and then now obviously the stop loss is too big, so we go to a lower time frame. We go to a lower time frame and then refine it. Simple. Then we refine it. Okay. Like how are we refining it? We're not going to refine it into inside of this or inside of this or inside of this. We're not going to do that. Okay, we're going to refine it to this price level. Okay, so no, it has a wick. See now, you know, from broker to now this is under. Okay, from broker to broker, the information like the data will differ. Okay, so I'm trading FTMO. So on FTMO, this wick right here was not present. Okay, which means from this to this, there is an imbalance. Can you understand that? From this to this, there is an imbalance. So I'm refining it down to this candle. This is how I refine it. Okay. See that it's still the same 15-minute POI. Look at this. Okay, it's the same 15-minute point of interest. See, it's the 15-minute point of interest right here. See that? This is the last push up before the push down. We refined it to a 1 minute only to reduce our stop loss. Can you understand that? I hope it's clear why I did that. Yeah, right? Okay, and then this is where I'm selling. Sell right here. Stop loss above this high. Okay, 2 pip stop loss above that high. And then where am I targeting? The low of the range. Very simple. See that? The low of the range. See, 75 pips. Easy. See, it's the pattern. It's the pattern. Okay, now if we do a quick recap, look at this. What did price do? Took out liquidity, broke structure, inducement. Once again, took out liquidity, broke structure, inducement. Sell. See, if the pattern is present, okay, you can like be 90% sure of your trade. Okay, 90% you can be sure of your trade. Can you understand that? Okay, it's the pattern. It's the pattern that you should look for. Okay, again and again, again and again. It's the pattern that you should look for. Okay, I hope everything's clear now. It's clear, right? Okay. So what else? Do you have any questions? Do you have any questions regarding what I told you now? Okay, do you have any questions, or should I show more examples? Tell me. What should we do? Because this is pretty much everything I do. Okay, this is like pretty much everything I do. Okay, nothing else. The only thing you need to know is look at the pattern. Look at the pattern. Okay, look at the pattern. See, for everything we wanted the pattern. We had this order block, came back down, inducement, wait for that to get taken out. Buy. Okay, even this you saw that. Okay, from the 4 hour to the 15 minute to the 1 minute, we did the same thing. Okay, we did the same thing. Okay, so can you understand? And remember, this happens on currencies, this happens on gold, this happens on these metals, indices, crypto, anything. Okay, you can trade anything with this. Okay, but the thing is, you need to do a lot of back testing and train your eyes into seeing this pattern again and again. Okay, so I hope everything's clear. It's clear, right? Okay, yeah, if you have any questions you can ask me. Okay, because I'll add you to a private group after this. Okay, so like there are breakdowns of the trades and stuff, so you can like learn from those two. Okay, you can learn from those two. So like if you have any other questions, you can just send me a message. Okay, send me your charts and ask me. Okay, send me your charts and then ask me questions. Okay, so that's it. Okay, I hope everything's clear. You have the recording, you can watch it again and then do some back testing. Okay, do some back testing. Okay, so then let's end it here. Okay, you're welcome. You're welcome. So I hope you got something out of it. Okay, like you got something new out of it, right? Okay. So then I'll end it here. Okay, then take care and have a good day. Okay. Yeah, good, bro. Good. I'll send you a message. Okay, I'll add you to a group after this, and then that's it. Okay, have a good day then. Bye bye.